and welcome to the Business Standard Morning Show. I'm Nazia Iqbal. Let's take a look at the stories for the day. Successful sale of Air India to the Tata Group, Prime Minister Narendra Modi's government has restarted the country's long-stalled privatisation program, which had been kicked off by the Atal Bihari Vajpayee government in the late 1990s. With several high-profile privatisation deals lined up, including the sale of Bharat Petroleum, can Modi replicate Vajpayee's success? Watch this report.
The long-awaited sale of India's national carrier Air India is now done. The Tata Group has snapped up the loss-making airline 4 years after the government announced its intention to sell it. Air India is now back to the Tata stable 68 years after the government nationalized it. Tata Sons' enterprise value bid of Rs 18,000 crore with a cash component of Rs 2,700 crore was higher than the offer from a consortium led by SpiceJet chairman Ajay Singh. The acquisition gives the Tatas 141 planes and 900 slots at overseas airports, the most valuable of which are at London's Heathrow Airport. While this is the end of a long wait for the Tatas, it also marks the start of Narendra Modi's challenging privatization drive 7 years after he first took office. The United Progressive Alliance government, led by Manmohan Singh, had not done any privatization in its 10-year rule. Modi is looking to carry on the legacy of Atal Bihari Vajpayee, who has a formidable track record of selling several state-owned companies between 1999 and 2004. Before we dive into PM Modi's plans, let us first see how public sector enterprises privatized by the Vajpayee government have fared. The NDA government under Vajpayee managed to sell as many as 12 PSUs despite strong opposition from within the government and the bureaucracy. A separate Ministry of Disinvestment under Arun Shourie had gone ahead with privatization in the face of opposition from Bharatiya Janata Party's ideological parent, Rashtriya Swayamsevak Sangh or the RSS and its various wings. These PSUs were Modern Foods, Maruti Udyog, Bharat Aluminium Company, CMC, Hindustan Teleprinters, Hindustan Zinc, Indian Petrochemicals, Jessup & Co., Lagan Jewett Machinery, Pradeep Phosphates and Videsh Sanchar Nigam Limited. These companies have performed significantly well since moving into private hands. Iconic bread manufacturer Modern Foods was the first company to be privatized, and it was sold to Hindustan Unilever in 2000. In April 2016, the FMCG company changed hands again when Everstone Capital acquired it from Hindustan Unilever. And in February this year, it was again sold to the world's largest baking company, Mexico's Grupo Bimbo. It has a 35% share of India's bread market and a revenue of Rs 400 crore. Among the big names, Hindustan Zinc was sold to Anil Agarwal's Vedanta. Since its sale in 2002, Hindustan Zinc has increased its annual profits from just Rs 69 crore to Rs 8,000 crore in FY21. The central government still holds a 29.5% stake in Hindustan Zinc, which is now worth Rs 40,000 crore. Maruti Udyog, which was renamed Maruti Suzuki India after its sale to Japan's Suzuki Motor Corporation, today is India's biggest car maker, with a 50% share of the market. Videsh Sanchar Nigam Limited, which was sold to the Tata Group and later renamed Tata Communications, has more than doubled its annual revenue to Rs 17,000 crore since its privatization. Hardware maintenance company CMC was also purchased by Tata Sons in 2001 and was merged with India's largest software services company TCS in 2015. Fertilizer company Pradeep Phosphates got sold to Saroj Podar's Advents Group. Today, it boasts an annual revenue of Rs 5,000 crore. Indian Petrochemicals was bought by Mukesh Ambani's Reliance Industries. Coming back to PM Modi's privatization roadmap, his government aims to sell more than 24 public sector enterprises. Some of the big ticket sales include Bharat Petroleum, Shipping Corporation of India, Container Corporation of India and HLL Lifecare. Apart from this, 6 steel plants are also listed for sale, including Neelanchal Ispat Nigam, Durgapur Steel Plant, Salem Steel Plant and Rashtriya Ispat Nigam, also known as Vizag Steel. For its 52.98% stake in Bharat Petroleum, worth Rs 49,000 crore, the government has contenders in mining conglomerate Vedanta and global funds Apollo and I Squared Capital. They have been given access to the data room until November 15 for due diligence. But there could still be more delays in closing the deal, as the valuation will depend not just on the share performance but also on the premium that the government is willing to accept, as the winning bidder will get control of the company. Another company that's high on the government's agenda is India's largest shipping company. The plan is to sell its entire 64% stake in Shipping Corporation of India, besides privatization of Container Corporation, by divesting 30.8% of the 54.8% stake to a private company and transfer management control to a strategic investor. The government also wants to reduce the number of public sector banks in the country through sale to the private sector. However, weak financial performance and low valuations are seen as hurdles in selling public sector banks. The government also needs to amend banking laws to enable privatization of these banks. It also faces resistance from the All India Bank Employees Association, which has cited concerns over job security. The government's move to sell Vizag steel plant has also been met with opposition in Andhra Pradesh, with employees staging frequent protests. But if the Air India deal is anything to go by, the employees may get some protection after the sale. The centre has mandated Tata Sons to retain all Air India employees for 1 year, and if any of them is laid off after this period, the company must offer them a voluntary retirement scheme. The Air India deal has signaled that the government is willing to offer better terms to bidders in order to give a fillip to its privatization plan. To make the prospect of owning Air India more palatable to the new owners, the government took the bulk of the airline's debt to the extent of Rs 46,000 crore. The sale may be the first of many to come over the next few years. To shore up revenue, it has previously resorted to selling its stakes to other PSUs. Some examples include Hindustan Petroleum's sale to ONGC and Power Finance Corporation's acquisition of Rural Electrification Corporation. Last year, NTPC acquired government stakes in hydropower company THDC and Northeastern Electric Power Corporation. But with a steep goal to achieve, the government must find private buyers to achieve its targets. And now it has shown a greater intent to do so. Will the Air India stake sale set a template for more such deals? Let's wait and watch.
The Monetary Policy Report of the Reserve Bank of India has pegged economic growth at 7.8% for the next financial year, assuming normal monsoon and full vaccination against the COVID-19 virus. Let's take a look at the 10 most important takeaways from the report.
The Reserve Bank of India's biannual monetary policy report has projected 7.8% growth for the Indian economy in FY23, provided the monsoon next year is normal, supply chains are restored, India has completed COVID-19 vaccination of its citizens, and there are no exogenous factors. While announcing the review of the monetary policy on Friday, the RBI's 6-member Monetary Policy Committee retained the growth forecast for FY22 at 9.5% and lowered its projection for retail inflation from 5.7% to 5.3%. Let's look at the 10 most important takeaways from the RBI report. India's economic activity has been normalizing since June 2021 with the ebbing of the second COVID-19 wave, relaxation in restrictions, and improvement in the vaccination rate. Urban demand is likely to accelerate with the release of the pent-up demand. The government's focus on capital expenditure and reforms push, and large FDI flows provide a conducive environment for investment activity. There are signs of an increase in investment pipeline in the rest of 2021-22 and the coming year. Professional forecasters survey sees real GDP growth moving from 20.1% in Q1 of 2021-22 to 5.9% in Q4. It could be 13.1% in Q1 of 2022-23 due to a high base effect and 6.1% in Q2. 3-month ahead median inflation expectation for urban households came down by 50 basis points and 1-year projection by 60 basis points in the September 2021 round of the RBI survey. Manufacturing firms polled in the July-September 2021 round of Industrial Outlook survey expect the cost of raw materials and selling prices to increase further in the October-December quarter of 2021-22. Upside risks emanate from persistence of supply chain disruptions, any further hardening of global commodity prices, especially that of crude oil. Downside risks arise from an earlier than expected mending of supply chain disruptions, the persistence of weak demand, and a slack in the economy. Money market rates consistently traded below the reverse repo rate, the weighted average call rate, the operating target of monetary policy, on average traded 17 basis points below the floor of the corridor during the first half of the current financial year. Riding on surplus liquidity, commercial paper issuances increased substantially to Rs 10.1 trillion during the first half of FY22, compared with Rs 7.9 trillion during the same period last year. Commercial paper rates generally traded above the reverse repo rate, with an average spread of 46 basis points. Crude oil prices turned volatile since the second week of July. The dollar strengthened on the expectation of a US taper. Emerging market currencies depreciated after peaking in the second week of June, mainly due to the retrenchment of capital flows. If crude oil prices are 10% above the baseline, domestic inflation may be 30 basis points higher than the baseline and growth around 20 basis points weaker. For the rupee, a 5% depreciation from the baseline may increase domestic inflation by up to 20 basis points, while GDP growth could get a 15 basis point boost from increased exports.
How prepared is the mobile device ecosystem for the 5G technology, which is expected to be rolled out by next year? Will we again see the stutters that we had seen at the time of 4G? Will the prices come down in the sub 10,000 rupees handset segment? When will India's semiconductor chip shortage end? And is India ready to have its own fab ecosystem? Qualcomm VP and President for India and SAARC, Rajen Vagadia, answered all these questions in an exclusive interview with Business Standard's Surajit Das Gupta.
5G is now coming next year, hopefully. Everybody is wondering whether the mobile device space is going to be something like 4G, where it was stuttering in the beginning, or are we much better prepared?
I think this time around, Surajit, we have two advantages. We are having the trials which are ahead of the spectrum auction, which typically is the reverse, the other way around. So you have typically spectrum auctions, and then there are trials, and gradually the networks are settled, and then there is a ramp up of the network. This time, the advantage is on one side, we have the trials which are very aggressively going on. And the second side of the devices, we got a lot of headroom. So while Qualcomm was able to bring 5G and almost prepone globally 5G by a year, from 2019 to now was the time available for us. So somewhere early part of 2020, we in Qualcomm India started working with our partners, our brands, to bring the 5G devices into India. And despite the pandemic, we saw the first launch of 5G device in March of last year. And from then to now, we have probably more than 60 models already launched. We are also seeing the affordability of 5G, which has become one of the big objectives of Qualcomm. We expedited that affordability journey of 5G smartphones, and that is also going on. So what we are seeing is that even before the 5G networks are rolled out commercially, there will be a good, healthy ecosystem of millions of, or rather tens of millions of 5G phones which will be there.
Do you see the prices coming down to the sub 10,000 rupees segment?
The price transition is something which basically we have our OEMs who will have to decide how they want to bring the prices in. And they decide the pricing, not us. But what we do is, as an enabler to them, we have made affordable platforms of Snapdragon made available to them so they can launch these phones in the market. Now, if you watch the trend, we have currently devices anywhere between 15 and 20,000 rupees already on 5G. At no point of time in the history in India has a G migration on price point happened so quick. I would assume that it is not undoable and unthinkable to see that type of price points coming pretty soon.
There are a lot of startups, as you said, who are working in EV space and various other areas also. So what is the sort of strategy that you have for ventures to play a much bigger role in India than it was earlier?
I think the role we play is far more than just the venture investments. offering our engineering and our labs and all the access to engineering, which helps them, and testing, of course, to for a faster time to market and make the products commercial. We do invest in the startups too. And then we go to Qualcomm Ventures, which is actually, while it invests also in startups, it doesn't necessarily invest in only the startups which are a part of Qualcomm Design in India channel. It invests outside of that too.
How many startups have you invested in the country?
While we are incubated 77, we have not invested in all of them. In all, as far as ventures is concerned, we have invested in around 20 plus companies in India. And again, this is not a static number, Surajit. This keeps changing because you invest in new companies every year, but then you also exit a few companies. That's the nature of that business.
When do you think the chip shortage, which India is facing, will be over? What is your estimate?
Yeah, I think it's a problem which came up because of the sudden increase post the pandemic, which we all know that why it came. So I think as semblance comes in the supply chain, as the demands are more adjusted, the situation is gradually likely to improve. One thing which we are working towards is saying that there is some demand versus supply equity or semblance or equilibrium coming somewhere in early part of 22. And while some industries may still be plagued a little bit longer, for example, automobile works on larger or heavier nodes, or we call them more legacy nodes. The capacities of those nodes, as the market quickly gravitates, especially for the automotive, to more EV and more autonomous cars, is going to be a little bit of a catch-up game, and that may last a little bit longer.
One last question. Is India prepared to have its own semiconductor fab plant?
So yes and no. I think the market is huge. The opportunities are huge. I would say when we look at the fab, and we look at it as not one activity, which is the fab itself. There are quite a few things that come before the fab and after the fab. So it's actually a set of activities, and fab happens to be one of the activities. We tend to discuss that more than we tend to discuss the others, which are very much essential for the fab to exist or survive. So it all depends on where we want to look at and what we want to start with. I think the market is perfectly there for India. But when you look at any other country where fab is established, you see a lot of design capabilities. You have software parts and you have the design parts, EDSM parts, right? They are there. And then the fab is there, and then the testing is there, and that is the chain. Now, if you pick up that one piece, which is called the fab, you need a lot of infrastructure requirements, which are very stringent. I would say we need also that infrastructure to be in place where it's not just about land, it's about power, stable power. It's about availability of inert gases, availability of chemicals, availability of right transport. I would say we need to look at all of those aspects and then take a conscious call as a country where you want to start. You can start anywhere. Every piece has its own nuances. And as far as we want to look at the nuances and take a responsible call on it, that's perfectly fine. If you were to ask me personally, I would say the R&D of the semiconductor is probably more key to start with, and create that ecosystem of design capabilities, R&D capabilities of semiconductor. And India is capable with the skill and the talent which we have locally, and more companies and ecosystem should come, set up this, enable this sort of design and R&D. I think that's probably what we should look at.
Thank you very much, Rajan, for giving me your time. Wonderful to talk to you.
With the RBI policy behind us, markets will shift their focus towards corporate earnings and macroeconomic data during this holiday truncated week. What are the key triggers for the week, and what are tech charts suggesting for the markets? Let's find out.
Even as markets digest the Reserve Bank of India's monetary policy outcome, focus will now shift to corporate earnings and macroeconomic data. Last Friday, the RBI MPC voted unanimously to keep rates unchanged, and 5-1 in favour of continuing with its ongoing accommodative policy stance. However, what many are seeing as a first step towards policy normalization is the MPC's aggressive tapering of liquidity. Let us go to independent economist Madan Sabnavis for a quick analysis of the RBI's liquidity stance.
And the last thing has been on liquidity. I think that's something which the market was trying to guess if the RBI would mention or take any particular steps to roll back liquidity. Now, I think what the governor has done, which is very, very prudent, and I think it's been very forcefully done to say that whatever is being done in a very gradual manner. And even in terms of the V3R, which the RBI has spoken of, he said it's not variable reverse repo rate auctions, but it's more called voluntary reverse repo rate auctions. But that's what the true spirit is, that there will be these auctions held which could go right up to around 6 lakh crores by the time we go into December. And the banks would have a choice to park their surplus liquidity. But this, to my mind, is one way of absorbing liquidity, and the fact that there won't be any more GSAPs for the time being. Again, with a caveat attached that it could come in case it's required, and the RBI would, in the meantime, be using other instruments to control the market or sort of reduce the volatility in the market in terms of the yield curve movements, and this would be done through OMOs and Operation Twist. I think that gives a very balanced view of how the RBI would be looking at things. So I think the basic message is that no surprises, everything is going to be done in a gradual manner. Yes, there is surplus liquidity in the system. This is going to be absorbed in a very, very gradual manner. And more importantly, at any point of time, if there is need for the RBI to intervene, I think it's always there to do it.
For Nilesh Shah, Group President and MD of Kotak Mahindra AMC, the policy decision was a Main Hoon Na policy that aimed to support growth, keep inflation expectations under check, provide stability to financial markets, ensure adequate and appropriate liquidity, yield curve management, and ensure smooth passage of the government's borrowing program. In the near term, corporate earnings, economic data, and stock-specific developments will guide the markets. To begin with, Tata Group stocks, listed airline players, and disinvestment-bound PSU stocks will be on investors' radar today, after the government last Friday announced debt-laden Air India's acquisition by Tata Sons. Separately, shares of Tata Consultancy Services will react to the company's Q2 result, which was released after market hours on Friday. The third event for the day is Aditya Birla Sun Life AMC's listing. The IPO was subscribed 5.25 times and had received bids worth Rs 10,395 crore at the upper price band of Rs 712 per share. For the rest of the week, CPI-based inflation for September and IIP data for August are slated to be released tomorrow. This will be followed by wholesale inflation data for September on Thursday. On the earnings front, about 49 companies are scheduled to report their quarterly results this week. These include Infosys, Mindtree, Wipro, HCL Tech, HDFC Bank, and India Bulls Real Estate. Technically, weekly F&O data indicates a range of 17,000 to 18,200 for the Nifty, with support placed at 17,650. Any breach below this level could drag the index towards 17,500. The Nifty Bank Index, meanwhile, may trade within a range of 37,200 to 38,500 this week. As regards Sensex, a Fibonacci analysis suggests a broad range of 59,400 to 60,950 for the week. Globally, headwinds like US bond yields, high global commodity, oil and energy prices, and developments in China will guide sentiment across emerging markets.
The Employees Provident Fund, or EPF, has traditionally been the most common tool for most Indians, especially the salaried class, to save for their retirement corpus. But what is Provident Fund? We answer all your queries related to Provident Fund in this segment. An Employees Provident Fund is a government-managed retirement savings scheme for employees. Every month, employees contribute a part of their salary towards Provident Fund. The goal is to receive lump sum payments with interest at the time of retirement from employment. In India, the Employees Provident Fund Organization or EPFO is responsible for the regulation and management of provident funds. Now, who is eligible for Provident Fund? Legally, any employee who has a monthly salary of up to 15,000 rupees is eligible. But most Indian companies offer it to all employees as part of their salary package. If you have a higher salary, you can opt out of it at the beginning of your career. If you opt for EPF, you cannot opt out of it during the time of your employment at that workplace. Now let's talk about the contribution. The mandatory contribution is 12% of an employee's basic salary, credited to the employee's account at the end of every month. The employer usually contributes a matching amount. Of the latter contribution, 3.7% goes towards the Provident Fund component and the remaining 8.33% towards pension fund. Your employer opens the PF account for you. It is possible for you to operate it online with a universal account number or UAN. You can check your account balance and transfer your account while changing jobs. The UAN provided by EPFO is mainly used for tracking PF balance and PF claim status. The pooled funds often earn interest at a rate decided by the government. In March 2020, the EPFO lowered the interest rate on employees' provident fund to 8.50% for 2019-20 from 8.65% earlier. For the financial year of 2020-21, the interest rate was retained at 8.50%. There are two ways by which you can withdraw your provident fund. The first is when you reach the retirement age of 58 years. In this way, you apply for withdrawal of your provident fund through your employer and get your full PF corpus. Also, if you have been out of work for 2 months or more, you can apply and withdraw your full PF corpus after tax deduction. Another way to withdraw part of your corpus before retirement age in case of major life events like your marriage or your child's marriage, or for education, purchase of house or medical emergency. The portion of the corpus that you can withdraw is different in case of each of these events. Details of these are available on the website of the EPFO. Finance Minister Nirmala Sitharaman had announced in her Union Budget for 2021-22 that interest earned on employees' annual contribution beyond 2.5 lakh rupees to their PF would be taxed. Taking this announcement forward, the Central Board of Direct Taxes notified the rules for these on August 31st. The threshold is higher at 5 lakh rupees for cases where only employees contribute to the PF, not the employer. Here are the highlights of the new rules. Every EPF subscriber's account will have two components, taxable and non-taxable. Interest earned will be separately calculated on both accounts from FY 21-22. These new rules come into effect from April 1st, 2022. So contributions made till March 31st, 2021 will be considered non-taxable. You can keep yourself updated about the new rules regarding Provident Fund by frequently checking the EPFO website. That's all we have for you today. We will be back tomorrow with more news and analysis in our next episode. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.